So what if I told you there's one simple number that could act like a crystal ball for the economy? Something that signals booms, busts, and maybe even the end of a major market cycle. Today, we're going to dive deep into the gold-silver ratio to see if it really holds the key.
You know, for investors, it's the classic question, right? Do you bet on gold, the ultimate safe haven? Or do you go with silver, the industrial powerhouse? But what if the real secret isn't picking one over the other, but understanding the powerful relationship between them? Well, that's where the gold-silver ratio comes in. It's just a single number, but it's incredibly powerful. It tells us exactly how these two metals are valued against each other at any given moment. So, let's break down what that really means. All right, so first things first, what is this ratio exactly? It's super simple. It's just how many ounces of silver it takes to buy one single ounce of gold. Think of it like the exchange rate between the two most famous precious metals on the planet. Okay, but a number is just a number until you know how to read it, right? So let's decode what the market is actually telling us through this one little number.
Let's make this totally concrete. Imagine you look up the gold-silver ratio and the number is 54.7. What on earth is that actually telling you?
It's really straightforward. It just means that on that particular day, you'd need to trade about 55 ounces of silver to get your hands on one single ounce of gold. That's it.
And this brings us to the absolute key. If you remember one thing, make it this. When the ratio is high, it means silver is relatively cheap compared to gold. When the ratio is low, silver is relatively expensive. That's the golden rule, and it unlocks everything else we're about to talk about.
So here's how investors actually use that rule. They look at history. A ratio way up above 80, well, that often suggests silver is looking like a bargain. But if it drops below 50, the tables turn, and maybe gold is the one that's undervalued. That zone right in the middle, that's kind of the historical sweet spot.
Okay, so we know what it is and we know how to read it. Now for the really fascinating part. This ratio gives us an incredible window into history. It's not some abstract number. It acts like an economic barometer, rising and falling with huge global events.
I mean, just look at this. During moments of pure panic, like the 2008 financial crisis and the start of the 2020 pandemic, investors run for the safety of gold, and boom, the ratio spikes. But then, during times of optimism and expansion, like in 2011, industrial demand for silver goes through the roof, and the ratio falls as silver plays catch-up. It's this constant dance between fear and optimism. Now, that historical pattern of fear and optimism is definitely still in play, but it's not the whole story anymore. Not even close. Today, there are these powerful new forces shaping the market, creating a dynamic that, frankly, we've never really seen before.
And you can see the divide is just stark. Gold's value is being driven by big picture stuff, geopolitics, central banks stockpiling it, fears about currency. On the flip side, silver is being pulled into the future by this relentless industrial demand. We're talking AI data centers, solar panels, EVs, you name it.
Just think about it. When the US froze Russia's reserves, central banks all over the world started buying physical gold as a hedge against that kind of risk. At the very same time, the explosive growth of AI is creating a massive need for data centers. And what do they rely on? Silver, for its unbeatable electrical conductivity. So you've got both metals in a huge bull market, but for completely different reasons.
And all of this, it brings us to the ratio's most powerful and maybe its most controversial use, as a potential warning signal for the whole market. Because at the end of every big run-up, the question is always the same. How do you know when the party might be coming to an end? Well, the gold-silver ratio offers a pretty compelling clue.
See, history shows this pretty clear three-step pattern. First, in the late stages of a bull market, speculative excitement pushes silver to start outperforming gold. And why silver? Well, because it's a much smaller, more volatile market, so a rush of speculative money can send its price soaring way faster. This causes the ratio to fall, sometimes really dramatically. When that ratio hits historic lows, it serves as a powerful warning that the cycle may be getting close to its peak. The source material really nails it. It says, a sharply falling gold-to-silver ratio will likely serve as a warning that the current bull market is nearing its conclusion. Now look, it's not a crystal ball with a specific date on it, but it is one of the most reliable indicators we have that the market's mood is shifting from steady growth to, well, speculative froth.
So for over 100 years, this ratio has been a pretty solid guide through all the booms and busts. But today, in a world where gold is driven by new geopolitical fears, and silver is being powered by an AI-driven industrial revolution, we have to ask, will the old rules still apply? That right there is the billion-dollar question we should all be keeping an eye on.